welcome and thank you for taking some time out of your busy day. This is Andy Fishman, one of the partners and advisors at Affiance Financial. You can't see, but I have Seth Meisler, the Chief Investment Officer and partner at Affiance to my left, and Steve Lear, partner and financial advisor to my right. You will hear from them as well. I mostly wanted to tell everybody a little bit about the logistics. But before I do that, I'm going to make one or two or maybe three comments. One is investing is scary, and investing is hard in down markets. And keep that in mind. I know a lot of people have heard Warren Buffett say that when everybody's fearful, I want to be greedy, and when everybody's greedy, I want to be fearful. This is the time where it gets a little bit scarier in the investment world. And the headline news does not help us in regards to this. That is pervasive, it's all over, and it tends to bring out the worries for everyone. So keep some of that in mind as we talk about what's going on right now. So thank you again for joining. A couple of logistics. I want to start out by clarifying the call is just that. It's a call. It's not a presentation by us. We'll have a few talking points, but there's no visuals for anyone to see. So you're not missing anything by just listening. Due to the number of people on the call, we have muted everyone. So we'll allow questions. I think it's in the Zoom section of it, and it's a Q&A function that you will be able to ask questions. And please ask those questions. We'll make our comments and then certainly open it up to the questions. So don't hesitate to ask us as the advisors. Finally, I mentioned who is on this. The topics today are to provide a discussion, to give you our ear and listen, but also provide you some feedback. We will let you know some of the actions and some of the steps we're taking to help manage and steward all of the portfolios. Seth will give you some narrative on that. So as we get started here, please allow us to answer those questions. Be patient with us. There's a fair amount of uncertainty, but we will continue to work hard, and we will develop the plans that meet each one of you individually as you move forward with your goals and objectives and your portfolios. So without, I guess, further ado, let's move forward with Seth and a little bit of narrative on what we're trying to accomplish today. So thank you.
Thank you, Andy. First, I'd like to give a quick thanks to our marketing group who was able to put this together on such short notice. It's been probably, 10 to 12 years since we had something like this before, and where we thought that the drop in the market was significant enough to reach out to you in a very short time frame. I'm going to start off with some prepared remarks, and which you can type in the questions, and then at the end of it, after Steve's conclusion, we'll answer any questions that you have. First, I want to say that our thoughts and prayers are with those families who have been impacted by the virus. We continue to see a rise in that global coronavirus epidemic in the US, and we are not epidemiologists, and the news is changing very, very quickly. So we're going to do our best to try and separate out what we know and what we don't know. So far, what we know is that the rate of infections outside of China is growing and has tripled in the last week alone. There are about 400 confirmed cases in the United States. Countries are definitely taking measures to stop the spread of this disease. That includes Italy shutting down its borders as of yesterday. France had 120 schools closed and over 1,400 cases of coronavirus. And we've seen universities close, Princeton this morning, and other universities will be following suit, it appears to be. In addition, the US has restricted travel to a number of countries. The absolute number of deaths so far pales in comparison to deaths from the flu in the United States, where last year the death toll was as much as 60,000 people. We also know that the Spanish flu is not the best comparison to today's outbreak, as they did not have antibiotics in 1918, nor the level of global mobility as we have today. We have seen a swift response from both the central bank and the federal government. The U.S. Federal Reserve cut interest rates by 0.5% last week in a rare intra-meeting event. They are clearly concerned and may cut their rates again in next week's meeting. We also had last week an $8.3 billion emergency spending bill, which was signed for both drug research as well as assisting state and local governments in their ability to respond to this threat. Canada has followed rates with a 0.5% rate cut, and China has also cut rates. I would expect fiscal policy and central bank stimulus to be worldwide as countries try to reduce the impact of the expected slowdown. And as of yesterday, after market hours, there was more talk of additional fiscal stimulus, which could include tax cuts or government spending. Obviously, it's too early to tell. What we don't know, we don't really know the true mortality rate for this specific virus, because we really don't know who is infected, and our data is really not great today. The best guess today is that the mortality rate is somewhere between 1 to 3%, which is 20 to 60 times greater than the flu, which is about 0.1% of those infected unfortunately die. We believe that the coronavirus is also more contagious than the ordinary flu. We also don't know how consumers are going to react to the coronavirus and how this will change consumer spending behavior, which includes travel, movies, dining out, etc. How is this going to affect the economy and our investments? We'll start with the economy first. And I want to preface it by saying that the economy is not the same as the stock market, and the stock market is not the same as the economy. At the beginning of the year, we felt positive about the economy and felt that the chance of a recession was very low. We believe that things have changed with the coronavirus, that in the short run, we believe that this epidemic will get worse before it gets better. But we do believe that it will get better, it will pass. Our best guess today is that this event may be enough to lead us into a recession. And when we talk about a recession, what we mean is 2 quarters where the growth rate is shrinking. It is possible that this recession is relatively mild. We've had other cases of epidemics where there was no recession. However, we had an additional impact to the market as of this weekend, which is that Saudi Arabia cut oil prices due to a failed agreement with Russia. And over the weekend, oil prices were driven down by about 30%. Oil price cuts hit a highly sensitive area of the economy in that they impact both the U.S. energy industry as well as our banking industry. While cheap oil and gas is a benefit for consumers, today the energy industry and the oil industry is a very large part of the U.S. economy. How do we think this is going to impact the stock market? So market meltdowns tend to happen very quickly and sharply, and this adds to our stress level. But we have been here before. We've seen epidemics like this, like SARS and Ebola, and we've seen consumer spending impacts like Y2K or 9/11, clearly 2007 through 2009, but we've had other impacts to the economy in 2018, 2016, 2013, and 2011. So while it feels extremely painful in the moment, in hindsight, it does feel like a distant memory. However, I don't want to negate the emotions we feel today, and those emotions are very powerful. What's important to note is that our strategies are risk focused. You are not 100% in the stock market for a reason. You're in a diversified portfolio, and those diversified portfolios provide downside risk protection. Bonds may not be attractive for their yields today, but we believe they're an important part of the portfolio because of the fact that they tend to do well when the stock market falls and everyone is looking for safety. So we think that this correction in the stock market is likely to continue in the short run, but as we saw today, there's a good chance of a strong bounce back, and we've seen that before as well. The positive note is that stocks do look more attractive on a long-term basis today than they did at the beginning of the year, something that was a concern that we noted in our market commentary at the beginning of the year. We don't know when the market will stop falling and when is the perfect time to sell or buy. but we do know that the current situation is going to pass. Longer term, we are still a believer in the stock market and the power of ownership. We are in the process of looking for opportunities of rebalancing and making those changes, and that is currently ongoing today and this week. In addition, there's some other things that you can do or keep in mind. One is that if you have a mortgage, now is a good time to look into refinancing your mortgage. In addition, because of the drop in valuation, it is a good time to consider converting IRAs to Roth IRAs. With that, I'm going to turn it over to Steve, who will wrap things up.
Seth, that was incredible. That was to the point, I think very well stated, and very proud that our investment committee and all the people who are involved assisted in preparing those comments. Thanks. It's interesting that 11 years ago, yesterday, was the absolute bottom of the 2007-2009 downturn in the markets. It was March 9th, 2019 was the actual bottom of that time. It was 2009, yes. So it's been 11 years since that moment has occurred. And it's interesting, we're now in another global panic. There's a common thread to this global panic. And this is one of the things that I very much appreciate as I get older, is how much little I actually know. So I have embraced this entire concept, which permeates throughout our firm, called "We believe in the certainty of uncertainty," and we hope to pass that on to you as well. And many of you have taught us this as well. It simply means we just don't know. We don't know. So what has occurred is that our investment committee, our financial advisors, live by this thought of the certainty of uncertainty, and the way that we strive to assist you to get to where you want to go is through something we call the smart money philosophy, which is stated in a different way, is always having a smart place to go to get money when you need it. So in conclusion, what we continue to ask is that you be open to us and tell us what you need, when you need it, and you allowed us to put our planning hats on and integrate the planning aspects of your finances into the investment aspects of your life. So at this point in time, there's no questions? Okay, well, I have a question.
I opened up the chat as well, so if anyone wants to use that instead of the Q&A.
Okay, there's a chat box that is open that you can use that to ask any question that you might have. But I do have a question, Seth. You're not a doctor, so I don't know if you know this or not, either of you. What is going on in China now with regards to the virus? Do you have any idea?
Yeah, actually, it appears that in China, the virus appears to be somewhat contained, and that the number of cases has been dropping. So that's what we've been seeing so far. China's a little bit in a, I would say, a little bit in a tough spot, in that they are allowed to do things because of the state-run government that we would not do here in the United States. In their tough spot is that they really have a choice between ramping up manufacturing, which has kind of been dormant for the last 4 to 6 weeks. And if they do ramp up manufacturing, that could increase the spread of the virus, or shut things down, which would hurt them economically, and also could cause suppliers to move to other states, other countries, Vietnam, etc. Right now, it appears that China is going to start ramping up ramping up their production. One of the questions that we have is there a buying opportunity in the dip?
Go ahead.
So, okay, I'll take that. So I would say, yeah, in times like this, going with the herd or going with our gut is the wrong strategy. And we have witnessed other situations similar to this where selling in the midst of a panic is a bad strategy. We are big believers in having a disciplined strategy and sticking with that discipline. And we do see a buying opportunity currently. And we are in the process of looking for entry points to go in and rebalance your portfolios and buy when we think valuations are attractive.
Let me just add to that. So as Seth mentioned, we do provide a disciplined approach to the portfolios. And as many have heard us say, as we've looked at the portfolios, that we will adjust them or rebalance the portfolios when the opportunity presents itself. And we are now in that territory where that opportunity to rebalance and adjust the portfolios will happen. We're in the process of reviewing and executing and looking at all of those opportunities. So don't be surprised if you see some execution on adjusting and rebalancing the portfolios.
I have been asked a question, which is, when you say we have a safe place to go with our money, what really do you mean? Well, I've personally just used the money market accounts and the short-term bond accounts that we have within our portfolios. I've got a wedding coming up. I got a house closing that's coming up, and all of that money has been sitting in a money market situation for at least 6 months to a year. And so I'm not earning very much money on that, but the idea was I knew I was going to spend that money, and I didn't want to have to worry about the markets, either the bond or the stock markets going up and down. I just left it in cash. So I just went with the peace of mind game.
Let me just, Steve, that's good. Let me just piggyback on that. So what we reference in a good place to get money is that I don't know everybody individually that's on this call, and so I'll state this more in aggregate. But as people begin to withdraw money from a portfolio, the reason we have a balanced, diversified approach, or bonds, as Seth stated, is that so that when there might be a time like this, we would look to the more conservative parts of the portfolio to withdraw funds to help you maintain your standard of living. Because right now, all of that section, we'll call it the bonds and cash, that part of the portfolio has actually gone up. And then when things turn, which they will, we would replenish the conservative areas to get back to that balance. So that's what we mean by always having a good place to pull money from.
Okay, a couple of questions we've received on the same theme, which is, if you have a large rollover, would it make sense to hold off or invest? So we've actually done a lot of work on this, and on average, the answer is that you are better off investing the rollover. Statistically, because of the fact that more times than not, the stock market tends to go up, and we also have an inability to know which way the market is going to go on a day-to-day basis, or when that entry point would be. Our recommendation is generally to invest the dollars, because over the long run, what we're experiencing now fades in time. And so even if there was an additional 5% loss that the market experienced, again, over a 10, 20, 30-year investing time horizon, it becomes relatively insignificant. So our opinion is that it's better to invest today.
Seth, is there is there any other approach? Because some of our clients, I know you look at it from a very historical, analytical standpoint, and some of our clients look at things with regards to the sleep factor. Is there any other way that somebody who's got a rollover that they're dealing with might want to consider investing at this time?
One thing that you may want to consider is if you could invest in a lower asset allocation. So if you, let's say, think that you are 70%, you could drop it down to a 50-50, and you could try that out. And maybe this is really a better gauge of what your risk tolerance really is for the long haul. So this is always a good gut check of that.
Everyone's on that particular, we don't want to, spend too much more time on this one, but as people are looking to invest money, yes, over time, when you go in doesn't generally make a difference, but human behavior, emotions, we understand all that. And it's a very scary time to be investing money right now. We get that because we have our own money invested and we don't like it to go down. But one of the strategies you can always do is, sometimes people refer to it as a dollar cost averaging, and you enter into this kind of an environment over time. You invest money over time, whether that's monthly, quarterly, that could be discussed with your advisor, but you enter into the market over time, and that will help mitigate some of the concerns of possibly falling more in the market. What's the other? Another question here is, given how low interest rates are, what happens if they go to zero, i.e. the Fed funds rate zero? Not good.
Mortgages become really cheap.
The reason the monetary side or the Federal Reserve would lower rates or lower rates to zero is a way to stimulate the economy. And so by them doing or executing that action, they're telling you that they're seeing some slowness in the marketplace, in the economy. And remember what Seth said, the economy and the stock market are different, but it's an indication that things have slowed down, and that would be a stimulus type of package. So once you get to zero, though, the marginal impact is pretty difficult, as you see in Japan and or Europe. So I think they're going to be cautious about how much more they're going to lower interest rates. Is that fair?
Yeah. So we have another question on interest rates. I'll just kind of continue that theme. What's the impact of current interest rate reductions and possible future reductions have on the market? So I would say, in general, my thoughts are that the 2019 big run up in the stock market was a direct result of Federal Reserve easing, dropping interest rates 0.75%, as well as increasing their balance sheet. So I think that gives you a pretty good idea of what the Federal Reserve can do to the stock market in general. Clearly, there are other factors that are creating greater headwinds for the stock market. And so the question is that going to be enough? I think in the long run, the answer is yes, it will be. And that this health issue that we're experiencing will go away.
Another question on waiting for the Federal Reserve to meet again to lower interest rates to refinance your home. So they're doing that next week. But the answer is that we cannot predict interest rates. We don't know if interest rates are going up or down. Thus, we also don't know markets go up or down. So it's really challenging to predict something. I guess what I would do, and this is all on an individual basis, and by all means call us individually, and as advisors, we can run the math and we can help you answer this. but it pertains to what your current interest rate is and what you might be able to get as a new interest rate will lead us to a decision, an informed decision on whether it makes sense to move forward with a refinancing. So we all know how to do the math. We all know how to assist in this area. And that's what I would recommend about refinancing and whether it makes sense to try to wait a week or so or not.
You want Steve, your question get answered? Okay. All right. Continuing on the housing theme, do you have any feeling on whether these current conditions will have any effect on the housing industry? Specifically, if you're looking at a seller or buyer's market for new or currently owned homes. Just bought a house.
It's attractive with rates low.
So I would say, generally speaking, if rates are lower, that means that people can afford more house. And so historically, that has been good for housing prices. In other words, an increase in housing prices, which I guess would be more of a seller's market than buyer's market. But I think a lot of it is local. In other words, what's the housing supply and demand? And so interest rates is only one part of that story. Any thought? Since you bought a house.
Well, I bought a house before this, and interestingly enough, the cost of this home is going to be less on a monthly basis than the rent that I was paying, so it was just fine. But I do have a number of young people who are really trying to think about moving into a different home, but because their work might be a little concerning of whether they were going to continue to have the jobs, whether they were going to continue to make the kinds of dollars. And I don't know how that is going to affect the housing value. I'm seeing everything is going to, in essence, slow down until we get through with this. And then it's a question of, is there going to be something else that's going to come? Or are we just going to kind of go back to what we were doing in 2019? So housing valuations, too early to tell.
Here's another question, which actually pertains to the smart money philosophy and a good place to take money from. So the question is, if we have enough in cash, should we put our monthly draw on hold for a while? And the answer again would be personal, but it certainly would be worth a conversation again directly with your advisor. And the concept would still make sense under the having a good place to take money. So if the answer was we were having to sell equities to support your withdrawal, then yes, it would make sense to take some of it from cash until you got to a point that you were not comfortable, a level of cash, and then look to somewhere else. But that falls under the good place to take money from. So the answer would be yes, take it from your cash if you were selling or the money was coming from another spot that we would not want to sell right now. So I would recommend, again, a kind of a conversation with your advisor directly on that. But hopefully that gives some perspective on that topic. Want me to do this?
Sure.
All right. So another question was, it's about a new funds being transferred in, and is this a pretty good time to do this, or what is it? Or is it actually a great time as we get more bang for the buck? Well, the answer is based on our approach, which is a disciplined investment strategy. And that is actually what we're doing for all clients right now with the view of rebalancing and adjusting. Sure, if the market is down 10, 15% and you have cash and you're being an investor right now, yeah, it's a fantastic time to be creating your comfortable investment strategy and then moving forward. I would suspect that the strategy is still not 100% in the market, but this would be a discussion directly with your advisor again. But the overall comment would be, yeah, it's a good time to be a buyer. You're buying on sale. And it's a funny area is that when we go to a store and we want to buy a blouse or we want to buy a pair of shoes, we always want to buy them on sale or at a discount. But investments is one area that people seem to not want to buy on sale. And this happens. So we've been at this a long time in this firm. And we understand the times when it gets emotional, the times when it gets scary, but these things do pass and markets tend to go up. And then people look back and say, well, boy, I should have maybe been a buyer, or I should have held tough with my portfolio. And that's what we're here for, is to help walk through that, discuss that, and hopefully provide some feedback and answers that will help you make good decisions regarding your portfolio.
Good answer.
Question I have received is, which factor is worse, the epidemic or the drop in oil prices, and what represents the greater risk to the economy? So I think I'll try to separate out short-term versus long-term. I would say short-term, actually, I think the oil price drop is probably the more significant risk that we're seeing, because we're beginning to see credit lending kind of lock up. And that becomes very concerning in terms of just the functioning of government. And I think we may see more central bank actions to deal with that. So short term, that is, I would say, the larger issue. Longer term, the consumer drives 70% of the economy. And that's going to become the question is, are consumers going to change their behavior for a period of time? If it's just, again, a couple weeks or regional in certain areas, then it may not be that big of a deal of the epidemic. But if it becomes global for, I don't know, a longer period of time, that's where we would be concerned that that would affect both economy and stock market. So right now it's a little bit of a double whammy, and so you're having both short-term impacts and longer-term impacts, but the longer term is really unknown at this point in time.
Other questions? Okay. I think we've hopefully answered all the questions, provided, as I said earlier, an ear for everyone. Please do not hesitate to contact us individually, email, phone call. We will be accessible, and we will certainly provide you an open, honest approach to what we're doing. We do appreciate everyone. We do not take what we do for granted, and we concentrate on solid portfolios, adjustments, and keeping up to date with the information that will be beneficial to all of you. So as Seth likes to say, we take it very seriously to be stewards of your financial house, and we do appreciate the opportunity to be involved with everyone. So those are my closing comments. I don't know if you want to.
Thank you.
Thank you.
Thank you, everyone, and have a great rest of the day or afternoon or evening, wherever you may be. Thank you.